When it comes to investing, two giants stand out: Benjamin Graham, the father of value investing, and Philip Fisher, the pioneer of growth investing. While Graham focused on numbers, balance sheets, and undervalued assets, Fisher emphasized the importance of quality companies with exceptional growth potential. Fisher's book, Common Stocks and Uncommon Profits, first published in 1958, became a classic because it introduced a new way of thinking about investments. Instead of just asking, "Is this company cheap?" Fisher asked, "Does this company have the potential to keep growing and dominating its industry for decades?" This shift toward growth investing influenced generations of investors, including Warren Buffett, who has said that he is 85% Graham and 15% Fisher. Welcome to 10-Minute Books, the channel where we break down the world's most powerful books into practical lessons you can absorb in just 10 minutes. Today, we're exploring Common Stocks and Uncommon Profits by Philip Fisher, a guide to identifying outstanding companies and holding them for the long run. The central idea: buy great companies, not just cheap stocks. Fisher's core insight is that the best investments are not necessarily undervalued stocks, but companies with exceptional growth potential. He argued that investors should focus less on short-term price fluctuations and more on the long-term quality of the business. A cheap stock with no growth prospects may remain cheap forever, but a great company with strong leadership, innovative products, and expanding markets can deliver extraordinary returns for decades. The 15 points. At the heart of Fisher's philosophy is his famous list of 15 points qualitative factors to evaluate when considering a company. These aren't about spreadsheets or ratios, they're about the real-world qualities that make a business thrive. Let's highlight the most important ones. 1. Does the company have products or services with sufficient market potential to make possible a sizable increase in sales for years? In other words, does it operate in a growing industry? 2. Does management have determination to continue developing new products or processes to further increase sales? Growth requires innovation, not just one good idea. 3. How effective is the company's research and development? True growth companies reinvest heavily in innovation. 4. Does the company have a strong sales organization? Even the best product won't succeed without strong marketing and distribution. 5. Does the company have a worthwhile profit margin, and are those margins likely to stay strong? High margins suggest competitive advantage. 6. What is the company doing to maintain or improve its profit margins? Competitors will always try to catch up. The best companies innovate to stay ahead. 7. Does the company have outstanding labor and personnel relations? Employee satisfaction often translates into higher productivity and lower risk. 8. Does the company have strong executive leadership? Fisher insisted that great leadership is one of the most decisive factors in long-term success. 9. Does management have integrity? Honest, shareholder-friendly management matters more than flashy numbers. This 15 points checklist became Fisher's signature framework for evaluating growth stocks. Scuttlebutt, the art of gathering information. One of Fisher's unique contributions is what he called the scuttlebutt method. Instead of relying only on financial reports, he encouraged investors to gather information from people in and around the industry competitors, suppliers, customers, even former employees. By talking to people who interact with the company, you gain insights that numbers alone can't provide. Does management have a good reputation? Do customers truly love the product? Does the company treat its partners fairly? These answers often reveal more about the company's future than financial statements. Focus on the long term. Fisher emphasized that the real money in investing comes not from trading frequently, but from holding exceptional companies for the long term. He criticized the obsession with short-term price movements and quarterly earnings. His philosophy was simple: buy right and hold tight. If you've identified a truly outstanding company, you don't need to sell at the first sign of volatility. Instead, let compounding work its magic over decades. The dangers of over-diversification. While many investors spread their money across dozens of stocks, Fisher argued that this often dilutes returns. He recommended focusing on a smaller number of truly outstanding companies. Quality beats quantity. This doesn't mean putting all your money into one stock, but it does mean concentrating your capital where you have the highest conviction. When to sell. Fisher believed that selling should be rare. There are only a few valid reasons to sell a great stock. If you've made a fundamental mistake in your analysis, if the company's management loses integrity or competence, if the company's growth prospects permanently decline, otherwise, even if the stock price fluctuates, it's usually best to hold. Common mistakes investors make. Fisher warned against several common mistakes. Buying mediocre companies just because they look cheap. Failing to do deep research on management and culture. Selling too soon after small gains. Overreacting to short-term news or market volatility. The intelligent investor, Fisher argued, must resist these temptations and focus on long-term quality. Fisher versus Graham. It's helpful to compare Fisher's approach with Graham's. Graham focused on undervalued stocks, using balance sheets and earnings ratios to find bargains. Fisher focused on growth stocks, using qualitative analysis to find future leaders. Together, their philosophies shaped modern investing. Graham taught safety, Fisher taught vision. Warren Buffett famously said that he combined Graham's value foundation with Fisher's growth insights to become the investor he is today. Modern relevance. Though published in 1958, Fisher's lessons remain strikingly relevant. Today's tech giants, companies like Apple, Google, and Amazon, fit many of Fisher's criteria. They operate in growing markets, innovate constantly, have strong leadership, and enjoy wide profit margins. Fisher's principles guide modern growth investing, reminding us that the real secret is not numbers on a spreadsheet, but the human qualities behind a company's success. Criticism and balance. Some critics argue that Fisher's method is too qualitative and subjective. After all, judging management integrity or innovation potential isn't easy. Others point out that focusing heavily on a few stocks increases risk. But Fisher never claimed his method was foolproof. He argued that serious investors should be willing to do the hard work of research, use judgment carefully, and accept that no investment method eliminates risk entirely. The big takeaway: common stocks and uncommon profits teaches us that the best investments are not just cheap stocks, but great companies with strong potential for growth. By evaluating businesses with Fisher's 15 points, gathering scuttlebutt information, focusing on the long term, and resisting the urge to over-diversify or sell too soon, investors can achieve uncommon profits. The question is, are you chasing cheap prices, or are you searching for companies with true staying power? That was Common Stocks and Uncommon Profits by Philip Fisher, broken down in under 15 minutes. Which idea resonates most with you, the 15 points, the scuttlebutt method, or the focus on long-term growth? Share your thoughts in the comments below. And if you enjoyed this summary, make sure to hit that like button, subscribe to 10-Minute Books, and ring the bell so you never miss our weekly breakdowns of life-changing books. Thanks for watching, and remember, it's not about buying the cheapest stock. It's about owning the best businesses for the long run.